It is Thursday, May the 2nd.
Yes, it is.
And we had the Fed speak yesterday.
We really did. And the a market initially liked what they thought they heard, and then they took it back. And then this morning they reconsidered, and they hopefully 9:30, as early morning indicated, it's they liked it again.
Yeah, and I think all three indexes were up in pre-market trading. What was your takeaway from what the Fed speak was yesterday?
Jerome Powell said three things. He's not going to cut rates at the next meeting. No. Rates are not going to be cut. They could cut rates, but they're not expected to cut rates, even in all likelihood through the summer. The second thing was he's probably not going to have to increase rates.
Correct.
And that this whole thing of getting inflation to 2%, which he's still determined to do, is going to take longer than shorter.
Long, hard road to get there.
Right.
No doubt about that. One of my takeaways from it wasn't necessarily yesterday, but it's where we are, and I think it's happened in the last really few days, is that the 3-month Treasury bill and the 6-month Treasury bill have normalized, meaning you're not getting paid more for a 6-month Treasury or for a 3-month Treasury bill than a 6-month Treasury bill, which means that the inversion has flattened out, which is good.
And that's a good thing. And then you would hope, and if you could envision a yield curve or a long line, that's on this end.
It's on the short end.
And you would hope and would expect it to move on out, and that would be wave-like, and that would continue to occur.
And that's a healthy thing.
Yes.
And it's a good indicator of not having a recession anytime soon.
Right.
So we've been in the longest inversion in history of 600, how many days was it?
It was over 624, and we're in the we calculated somewhere the 650 to 680 range.
So 2 years longer than 1978, which was the reigning champion of inverted yield curves.
So we have it there. A lot of questions are coming in. Should we buy? Should we hold? Should we get out? And I would go back and say, remember we said we're going to keep our seatbelt signs on. For the most part, we're looking at holdings. We continue to look at holdings. They're strong holdings. They're good holdings. We're still in this desire to be somewhere at least 50-50 in the stock market. So we're going to see some volatility. But what we have is strong. And as we believe, this market will correct itself, and we will be in a position to take advantage of it. So we're steady as we go, and we monitor things on a very regular basis.
But the good news is what we just talked about is that the normalization of the short-term rates, and in our example, the Treasury bill rates, is a healthy thing, and it makes us a little bit more confident about where the economy is, at least right now.
We finished the radio show by giving the definition of stagflation, and if there is something that we will really keep our eyes on, it will be stagflation, because if that begins to develop, that could change things a lot. And that will be watching what employment is doing, that will be watching what inflation is doing, and that will be watching what consumers are doing in terms of spending money and the growth of the GDP.
Right, because the worst case scenario is stagflation.
Right.
Because you have inflation, you have increasing unemployment lines, and you have no to slow growth. So it's a bad combo, and we want to avoid that at all costs.
We continue to monitor your accounts on a very regular basis. If you have any questions, please give us a call. We're meeting, we're talking, we're Zooming. We're here for you. If you have somebody you'd like for us to meet, we're meeting new clients all the time. And we're grateful for you as great friends and great clients. And we do it because we know it's your money.
And your money matters. Have a great rest of the week and safe weekend, and we'll talk to you soon.
See you next week.